Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, LLC, member SIPC. My special guest, who I really enjoy being on the show with, is Patricia Dunn, Merrill Lynch, also a member of SIPC. And our special guest is Frederick Hubler, Jr., the Chief Wealth Strategist at Creative Capital Wealth Management Group. It's going to be a great show. Market's pretty turbulent, and stick with us. We'll see if we can help you figure out what's going on. Patricia, good to see you.
Good to see you again.
Okay, well, let's start talking about, a few years ago they had an event called the Flash Crash, where the market went down 1,000 and then it went back up 900 all in one day. And it seems like we had some echoes of that recently. I don't want to time the show because we don't want anybody making timing decisions based on what they hear today, but basically that's been starting to happen again. What do you think's going on?
I think we're definitely into the fear part of the fear and greed cycle. And I think that there's a lot of people out there that are feeling very uncertain, but the serious money is staying put. And it's also taking advantage of some of these dips.
Sure.
I think we have to narrow our view from a microscope to a telescope in this market.
Sure.
And think out a few months.
Excellent. And I feel the same way. When the market's chopping around with the computer trading, chasing each other and pushing it all around, I think you got to get back to the basics. Look at the stocks that you want to own, see if they've gotten cheap enough for what's going on in the world, and ignore all that volatility. And if it gets to the right price, just step in there, close your eyes, and buy it for the long run.
Exactly. Then put it in a drawer and don't think about it for a month or two.
Okay. Another question I'm hearing from a lot of clients, they're starting to wonder if interest rates are destined to stay lower than they originally expected for quite a while, maybe years. What do you think?
I don't think so. I think that there's been enough upheaval in the last few weeks that the Fed may put off the decision to normalize rates until maybe January, the first quarter. But it's not a question of rates going up because we're in high inflationary times.
Sure.
I think it's more that rates need to normalize.
Sure.
They've been artificially low for too long.
Well, just to review the bidding, historically the Fed has played with the short-term rates and they've let the long-term rates go where they may. And since 2008 they had to start playing these silly games where they artificially drove down interest rates, made the short-term rate zero to try to force people into other investments to get the economy going. And so now they're going to have to try to step back to their normal mode of playing with the short-term rates and hoping the long-term rates go where they belong and search out the correct level.
And I think they will.
Okay.
In our economy, if you leave things alone, they normalize.
Sure.
It's when you start messing with it.
Yeah, and it's going to be interesting to see how smoothly that goes when the Fed has intentionally perhaps pushed 30-year bonds 1% or 1.5% below where they otherwise would have been.
Right.
So it'll be interesting to watch that process, and especially when it has secondary effects on currencies and all that sort of thing. Okay, well, is the U.S. the only place to be right now, in your opinion?
No, I would have a healthy dose in the United States, Charlie, but I would not overlook Europe, and I would not be frightened by Greece. And Japan is another area where we're starting to see some growth. So I think developed markets in Europe and Japan is another place that it's important to add to a portfolio now.
Yeah, I noticed recently Japan announced a lowering of tax rates, which hadn't happened in a long time. So hopefully that'll provide some stimulus there. How about China while we're on the subject of Asia? Do you think that's going to sort of steady itself out after some more turmoil, or what do you think there?
I think we have another shoe to drop in China. I do think that we're going to go back down and test some lows there. So I would not be running into China now.
Okay. Another question I get from clients and friends, do you think the way interest rates have been acting and the market's been so choppy, is that predicting a recession?
No, just the opposite. I think it is a temporary set of volatility that's going to even itself out as we go forward. Don't forget, we've got an election year, presidential election year next year, and traditionally presidential election years are very good years for the stock market.
Yeah, Mr. Trump hasn't let me forget that there's an election year coming up. Trust me. Okay, well, let's talk about the Fed rate hike. Everyone is just, dithering over when's the Fed going to raise rates. Does it matter to you whether it's in September of 2015 or December of 2015 or early next year?
I don't think it makes any bit of difference at all, and I think that they're going to hold on with this rate hike, delay this rate hike until we get some sense of stability in the market, and then they'll do it. I don't think they want to add pepper to the pot.
Sure, and another factor, historically the Fed does not like to get involved with hiking interest rates just before an election. So I suspect whatever 2 or maybe 3 rate hikes they're going to do, they'll try to get done by the middle of 2016 at the latest.
I would agree with that.
Okay. Well, let's try to help one of our viewers. Marilyn Coyne of Plymouth Meeting says, what stocks win when interest rates rise? That's a pretty broad question, and you could take a half hour to answer it, but try to hit the high road if you could.
I will. Marilyn, it is a broad question. And let me put it from the 30,000-foot view and then bring it down closer. Historically, when the Fed has raised rates, within 12 months, the market is typically up 10%. That's a historical fact. Now, when you start thinking about which stocks, we don't recommend individual stocks on this program, so I would advise you to speak directly with your own personal financial advisor. But in broad stroke terms, Marilyn, you have to think of who's going to be the winners and who's going to be the losers when interest rates go up. And clearly winners typically are banks because they make their money on the spread. Mm-hmm. They take money in deposits and then they lend it out, and if they can charge a higher rate on the loan, they make a bigger spread. Who's going to be hurt? Somebody who is a very capital-intensive industry, namely utilities. Utilities are always borrowing money in order to keep generating electricity. So if their cost of capital is going to go up, it's going to have a negative impact. But for specific recommendations, Marilyn, talk to your individual financial advisor.
Since we got an extra minute, I'll expand a little bit. Part of the question is, why are rates rising? And as you pointed out, you don't believe there's any inflation coming. So if rates are rising because we have a healthy economy, then all of those investments that you've just talked about will follow that normal mode. If you go back to the late 70s, when interest rates were rising because there was a lot of incompetence in Washington and mortgages were climbing to 16%, that wasn't a good time to own anything, especially be buying a house or housing stocks, or the banks were going with it. But that was a very unusual set of circumstances.
And we also had the baby boomers entering the workforce in huge numbers, and that was distorting everything. We don't have that now. Millennials are not out there buying houses in big numbers. Millennials tend to want to rent.
Okay, well, we're getting started with our special guest a little early, but let me first put up the information in case you want to send in a question.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Again, our special guest is Fred Hubler of Creative Wealth Management Group. Fred, thanks for being here.
Thank you for having me.
How you doing?
Doing great.
I'm sure one of the questions you get asked all the time is, why should I be with your firm instead of some other firm?
It's a good question. Thank you for asking. I think our mission statement, which is unique solutions for extraordinary clients, really sums it up. We're independent, so what we offer is not anything we make in-house, which is good and bad. The good news is it can be very unique for the clients. The bad part is in-house, no one's telling us what to do. So we have to go out there and do a lot of research. I have CFPs on staff. I have a certified wealth strategist degree. I grew up with the X-Files, and I trust no one. I need to find it out for myself. And in our field, and you guys know this, a lot of people have their view of the world that tends to line their pockets if you believe in their view of the world. So we're very Ronald Reagan-ish, trust but verify. And I think at the end of the day, clients, it's a relationship. So clients will pick us for the relationship. We're planning-centric. So we'll plan first, and we currently only do asset management for clients that hire us for planning, which was really scary because people could come over with assets they want you to manage, and we've decided as a firm that we're not going to start there. We'll end up there and we'll help there, but we'll do a plan as the primary foundation, and it took 13 years to decide to do it that way, and just close your eyes and hope that clients will still show up and want to do a plan. And it's been awesome. It really has helped
That is a fairly
understand
unique
the client.
approach.
So being ahead of the crowd isn't bad, but being over here when the crowd's over there, you don't know until after that, where your location is. But we're proud of the choices we've made to kind of put the client first. And if you lead with asset management, that tends to sometimes muddy the water. And you'll have conversations about asset management, and the clients don't have a will. And you want to make sure that they have, things to, the things they want to do doesn't always mean they have to do them first. So we try to make sure the clients get what they want out of it, but we also sprinkle in the things that they know they need to be doing, and they don't.
Okay.
I'd like to take it in a slightly different direction, Fred. I was fascinated by your bio, and can you tell me what it means to be an NFL, PA, registered player, financial advisor?
Well, it's a mouthful. Besides being a mouthful, the background behind it was on a Friday, I got voted off the island. My office at a staff meeting said, just leave the office on Fridays. We'll catch up for everything that you promised people Monday through Thursday, and we'll prep your next week. So I'm home doing almost a Maslow's hierarchy. I searched for NFL and financial advisor, two things I love. And it turned out that the NFL Players Association had an open enrollment that was closing the very following Monday. So very serendipitous. I don't know why I looked for it, and I don't know when. It just happened to be at the right time. So there's about 300,000 financial advisors and less than 250 in the NFL Players Association registered financial advisor. And it's a outset and basically a result of all the stories we hear about financial mismanagement for the players, of the players, on the players, everything about the players. And so the NFL wanted to do something, and they can't recommend anybody, but they do have a very strict process. And so we filled out the application, spent the money to get in, completely forgot about it. 2 months later, I get a letter saying I'm going to training camp, and I'm now, I think, one of, if not the shortest person in the Players Association. And so what it does for current clients is they want to have a feather in their cap. They like to say, oh, my guy or my the firm that I work with is in the Players Association. And ironically, if you do that search today, if you do the NFL Financial Advisor, we're the first ones that show up as an organic result. I don't pay for it. I don't know how to stay on it. We got a call from a magazine, and I said, how did you even find us? They're like, well, we searched for best NFL financial advisor. You're the first one that shows up. And I have a headset at the office, so as I'm talking to the person, I'm typing it in, and I'm like, oh, you're right, and we weren't expecting it. So it's a good, I won't say PR, it's a good marketing differential.
Right.
At the end of the day, a player in football is very similar to a person getting ready for retirement. The equation is the same, the numbers are different. The amount they're starting with might be bigger, but they have to use it for longer.
Right.
They do have a lot of, unfortunately, a lot of ancillary issues that most people don't have. You don't have the peer pressure to buy your cousins a house, your mom a house. And I think all of us would have a hard time if our paycheck was only, whatever we get made in the year, was only over 16 weeks. That would be tough. Yeah. And when our paycheck is gross to us and we have to, every player I ever meet in conversation, I say, you have to pay taxes, you have to do a tax return for every away game. They think I'm kidding every time. No, if you're on the bench in Dallas, you're an entertainer, and you have to pay the city of Dallas taxes. So when a rock band goes on concert, their home office, their office manager, their manager gives Bono his cut of the check. Football players get their gross cut of the check, and they have to go to someone that says, all right, this goes to this person, and it's very sadly stacked up against them.
Yeah, a couple of years ago, the retiring chief investment officer of Vanguard mentioned he was starting to research trying to help NFL players, and he mentioned a statistic that within 5 years of retirement or leaving the game, 50% are broke. Does that sound right to you?
90% are broke or divorced. So even if you're not broke, you still have half your money.
Okay.
And the pensions and all the good stuff doesn't really kick in until you have 5 years that are credited. So you have to have a certain amount of games per year to be an accredited year, and the average tenure is less than 4.
Wow.
So it's all set up not to really pay out.
I noticed that in the research that you're in 13 states. What kind of technology do you use to keep up with all the people you need to talk to who are not geographically close?
Sure. My MBA is in technology management. So at the very high level, it tells you how to pay for something that's very expensive that's out of date in 6 months. But from without any clients, without any staff, I built the office with, there wasn't a name for it at the time, but with the cloud in mind. Basically, using technology, we could look bigger than we were. Now we're bigger than we're as big as we want to be. So we've invested in virtual presence software. So the client gets a link, and then they can see me, or they can not see me, depending on, I guess, what I look like or what their mood is. And then I can share my screen with them, and we can have an open dialogue both ways. Our cell phone, our office phones, are voice over IP, which is a fancy word for saying it's internet-based. So my cell phone can ring as if it's my office extension. And so everything that's cloud-based, if I add something on a client note, it's real-time to the rest of my staff. And that really helps continuity. We now get paid for what we accomplish, not for how long it takes to accomplish it. So the more I can be effective, the more I can be home with my 4-year-old twins, and having that work-life balance that I think we all get into the business to kind of get there at some point. So virtual presence software. We also invested in software that allows anyone in my office, when they log into their computer, it's actual virtual desktop. So whether it's at the office in our house or with wonderful Pennsylvania winters, it's out of their house, they're seeing their same desktop. So if they had an email half open or a file half written in Word, it's still there, even though they're connecting in it from their iPad or from their office. So I think short term, it might be a little bit more expensive than buying a computer that then runs it there. Long term, I couldn't think of working any other way. That way, if a client needs anything, as long as I have internet access, God willing, it's the only thing I need is internet access, everything works.
Cool.
Well, this may be a follow-up question, because I was also reading on your bio that you have something called meetings about you without you.
Yes, I wish I could trademark very generic things. So there's a few parts of how we built the practice, and it's based on, everything we've done is based on where it's working somewhere else. So how we invest is based on the institutional model. Unfortunately, clients pass away, institutions don't, and clients pay taxes, nonprofits don't. So, but there is asset allocation where institutions have always had a play. So we've built our playbook around that, and in part of that, having a family office typically is restricted to people that don't have $100 million. So our meetings about you, without you is part of that planning that is now how we go about our business. And what we wanted to do is see the other advisors as collaborators, not competition. If they have a great growth person, I'm not trying to do growth better. If they're at Vanguard, I'm not going to do Vanguard cheaper and just charge a fee to keep it at Vanguard. So we want to be more fair to the client and say, that's working over there, let's keep our eye on it, but we're not going to charge you for it, let's just make sure the allocation's okay. And what I realized was integrating advice. The more successful someone is, the more they're the person responsible for integrating the advice of all their different people. So we do like football. We use the football analogy. The clients own the team, and I'm the head coach. I don't have to be the quarterback. So the head coach can hire the quarterback. So if they have their brother-in-law as their stock guy, great, we're not replacing them. Their brother-in-law doesn't want to be doing the plan. Typically, their brother-in-law doesn't want to be doing the planning that we want to do, because that's not where they move the needle for their clients. And in addition, we like to use things that typically aren't traditional as an overlay to the client, to what the client already has. So we'll take 10 or 20% if it's appropriate and do some private equity, do some alternative investments that aren't going to be at their brother-in-law's shop, no matter what good of a shop it is. And it's such a small piece, the brother-in-laws of the world don't care. Like, oh, fine, we'll work together. Mm-hmm. So the meetings about you, without you is a way of saying we're going to meet with your lawyer and discuss, what we need to know by them. The more successful our clients, the less time they have. So we're meeting with their lawyer to make sure things are tight. And then we can, one of the benefits that we can do is we can kind of dumb it down so the client can understand it, have an off-billable to the lawyer, not billable by the lawyer, but an off-premise conversation. Say, well, here's what he's trying to do, and here's the pros and cons. We're not trying to give legal advice. We're trying to give it in a way that the client, oh, all right, now of course I'll do it that way. So we basically, once the other team members understand it, you call another advisor, they think there's a new sheriff in town and they're getting fired. And it takes 2 or 3 awkward, no, here's how it's going to work. We're not here to redo what you're doing or undo what you're doing, just want to coordinate it. By the 3rd or 4th phone call, they're ready to give their report of what they're doing. And they see us not as the person that we want to replace. They end up seeing us as the person they want to impress, so that we're on their side when we're in front of the client, because they're now part of what the client wanted is not to have 18 meetings with 14 different people.
Right.
So we have those meetings. We understand the client, what they need to do, and we'll triage it for the client to say, all right, I know you don't want to have this meeting with your lawyer, but you got to, and here's the prenup we said you needed to sign. Those conversations we kind of just make sure happen. And typically the team members that are outside of our office love it.
Okay, as I think about the nature of your business, I'm curious about 2 things, media and referrals. I would be curious as to how much media coverage there is, whether it's local or national, for this type of thing, helping a football player just so that he won't be broke. And then do you get a lot of internal referrals from the contacts that you have?
Sure. Well, the media is interesting. I got a phone call, and the office manager said you need to take the phone call, and it was the Wall Street Journal, and I thought they were trying to sell a subscription. And I said, I need to get this email, or whatever I was doing, what I thought was more important. And she's like, and the office manager said, you need to take it, they want to interview you. So that interview with the Wall Street Journal probably never would have happened if it wasn't for the NFL Players Association connection. Mm-hmm. And that was one of the first people I said, how'd you find me? They said, we searched for Best NFL. You're right there. And we talked not just about football, but about allocation and asset allocation. So I probably would not have been in the Wall Street Journal. Christian Science Monitor called, and the first thing, and by that now I'm kind of used to it, and I called, Tim Tebow's not a client. And we want to talk to you anyway. You have to have fun with it a little bit.
Sure.
American Banker was probably the weirdest thing, because I'm not a banker. We're not FDIC insured. And they called and they just wanted to know for their banking clients, which were bankers, not clienteles, but they wanted to know how the NFL program worked and whether it was great for business. And my short answer is it's great for business that's not NFL related, because the NFL related clients come with a lot more resource intensity than I have the patience necessarily to deal with. There was one client, we were looking at an investment, it was $100,000, 7%. And the client said, okay, so that's $7,000. I said, yes. Is that every month? I said, no, that's the annualized return for the year. I'm not wasting my money with that. I ended up buying a nightclub, losing a short, wasn't a client of ours. Yeah. And so when 7% of safe money doesn't get your attention, that conversation, they're not ready to have that conversation with me yet, typically.
It does sound like that. So how do you get them on the road map and start leading them down the right path? So
and the second question for the referrals is kind of the same thing. Once they have the aha moment, once they realize, oh, you're not trying to take my money, and I'm not the first person in the NFL going through this, I try to make, they're very competitive, so I try to make the competition to be, you don't want to be the guy that's broken 5 years, because that's where the numbers end. So you want to be the person, you've always been different than everyone else. How about you do it again this time and be different than everyone else that goes through this and have money at the end of the game? You know, you're in the equivalent of a car accident every Sunday. Most people aren't.
Right.
You need to save for that because most people won't even have the opportunity. We had one client who had a huge contract, and his only question, and I didn't mind that he hit me every time, you know, not hard, but yes, very contact oriented. I didn't mind that. His only question for me was how much you're going to make me. And I'm thinking to myself, you're not ready to do this. And he had tens of millions of dollars of a contract, and I basically said, you've already made it. You don't know it yet, but you've already made it. This is it. It's how much you want to make 50%, you have to risk 50% to maybe lose it all to have the chance of making 50%.
You should be thinking about the Will Rogers theory. I'm more interested in return of my investment than the return on my investment.
Exactly. So unfortunately in the sports world, I'm the one to say no, and they're not used to that. You know, the agent gives them the money. I take, I not take it away, but I put it in places where they can be safe. So the short answer is the NFL part of it helps with non-NFL referrals because clients like that. Oh, Fred's my guy, or my guys. You look them up. It also helps with getting attention, warranted or not, getting attention to say things that I think we stand for. Right after the flash crash, we talked about a local news channel called, and they said we want you to be on the radio, or when you be in the studio tomorrow. And I thought I would have killed 13 years ago for that opportunity. It was 5 o'clock in the morning, and I said no, thank you. Like, but this is an opportunity. I'm like, no, thank you. So then I realized, okay, it comes with good, and you need to, and I was glad because there's nothing I would have known by 5 o'clock the very next day to kind of put it in perspective that would have been a valid answer.
Pat, we got time for one more question.
Well, besides NFL players, who are some of your other clients?
Our wheelhouse is retirees, business owners, and working executives. And the high caliber working executives are almost cut from the identical same cloth as a football player.
Makes sense.
Maybe not the athletic, some of them can't do any sit-ups, but the mindset and where they are is almost linear with where a football player is who's also at the top of their game.
Well, we appreciate you being here. We had a long list of questions to ask, but it's so fascinating, and we really appreciate the insight. I'm glad somebody's trying to help these people because they should be helping society in future years with the incomes they get while they're young instead of being someone that is dependent on what society gives them. So you're doing some good work, and we appreciate you coming on the show.
Thank you for having me.
Yeah.
Pat, thanks for being here.
Sure.
Okay, well, next week we're going to have a good show. Our special guest will be Robert Smith, the CEO of Smith & Company, a commercial real estate company, and I think a big part of the question on where is the economy going is going to depend on real estate, not only commercial real estate but also residential. And if we can get that question answered, then we'll know a lot about how this crazy market is going to work itself out. I personally believe we're going to be fine. As far as we're concerned, your money matters.